Hey everyone, and welcome to another deep dive. Today, we're diving into a question we've been getting a lot lately. Those T-bill rates here in Singapore, they've been making some pretty noticeable moves lately.
Yeah.
And,
Yeah, they have.
we want to unpack why they're on this downward trend, what it means for your investments, and, maybe explore some other options you might want to think about.
Yeah, it's definitely got people talking, and for good reason. I mean, Singapore investors have always sort of counted on T-bills.
Right.
That sense of security and a decent return.
Yeah.
And lately, it seems like that's changing a bit.
It really does. I mean,
Yeah.
think back to July when one-year T-bill yields were at 3.38%.
Right.
Now fast forward to the last auction, and boom, they've dropped to 2.71%.
Yeah.
That is a big difference. So should we be hitting the panic button? Is this a temporary thing? What's going on?
It's not really a temporary blip. It's more like a sign of a bigger shift happening with interest rates globally.
Yeah.
You see what happens with the U.S. Federal Reserve. It kind of creates ripples everywhere.
Yep.
Their recent interest rate cut that they did, it has this domino effect, and it impacts central banks all over the world, including ours.
So it's like the Fed sneezes and Singapore's T-bill market gets a cold.
Kind of. You could put it that way. When U.S. interest rates go down, it tends to pull down T-bill yields in other countries, too.
Okay.
But here's the thing. This decline, it's not just about what the Fed did. It's also about what the market thinks is going to happen.
Oh, interesting. So you're saying investors are already kind of pricing in future Fed moves.
Exactly. The market is always trying to anticipate what's next.
Right.
So this drop in Singapore's T-bill yields, it also reflects this belief that the Fed is going to keep cutting rates in the coming months.
Okay, so we've got declining rates, we've got these global domino effects, we've got this whole market whispering about the future. I think I'm getting it.
Yeah.
But let's get down to what really matters here. What does this actually mean for someone in Singapore who's sitting on their money trying to figure out what to do? Should we all just hide our cash under the mattress now?
I don't think you need to resort to that just yet.
Okay, good.
It's understandable to feel a little uncertain when you see those T-bill rates shrinking, especially if you've always relied on them.
Right.
But remember, even with this dip, T-bills are still backed by the government.
Right.
That makes them a pretty safe and liquid option, particularly for those who are a bit more cautious or have short-term financial goals.
Okay, that is reassuring.
Yeah.
But I'm sure our listeners are wondering, are there smarter moves to be made in light of all this? What are people saying?
Well, there are basically two camps right now.
Okay.
Some experts believe that this could be a good time to lock in some longer-term T-bill yields before they potentially fall even further.
Interesting, like grabbing a discount while you still can.
Exactly, like a sale on security.
I like a good bargain. But what's the other side of that argument?
The other side sees this as a bit of a wake-up call. They're saying it might be time to diversify. Look at other investment options that could offer potentially better returns, particularly if you have time on your side and you're comfortable with a bit more risk.
Okay, better returns.
Yeah.
Now you've got my attention. So what are these mysterious alternative options? What else is out there besides T-bills?
Well, you've got your fixed deposits, a good old standby.
Yeah, those are familiar.
You've got Singapore savings bonds. Those are getting more and more popular.
Right.
Then there's the whole world of endowment plans.
Okay.
And of course, we can't forget about those high-interest savings accounts that always sound tempting.
Right.
And then for the more adventurous, there are always U.S. Treasury bills and corporate bonds.
Wow. Okay, so there's a lot more to this than meets the eye. But before we get into the specifics of each of those options, I think it's important to understand why this whole T-bill rate decline is causing such a stir in the first place.
Yeah.
This isn't just about individual investors like you and me.
Right.
This impacts the entire Singaporean economy.
Absolutely. It really does. These declining T-bill rates are a bit of a double-edged sword for businesses here in Singapore.
Okay, how so?
Well, on one hand, lower interest rates can be a good thing.
Okay.
That means borrowing money is cheaper, which can really help with investment and expansion.
Right.
We might even see businesses feeling a bit bolder about starting new projects or even hiring more people.
So potentially good news for growth.
It could be. But there's always another side to consider.
There always is. What's the catch?
Volatility. Especially when you're talking about foreign exchange markets.
Right.
Singapore's economy relies heavily on global trade.
Of course.
And these shifting interest rates can create a lot of uncertainty for businesses dealing with imports and exports.
Because it impacts currency exchange rates.
Exactly.
And if those are all over the place, it can make planning and budgeting a nightmare for businesses.
You got it.
Yeah.
And there's also the perception factor to consider.
What do you mean?
Well, if these declining T-bill rates are seen as a sign of a weakening economy, it could make businesses hesitant to invest and expand, which could then actually slow down economic growth.
Okay, so it's not all sunshine and rainbows. It sounds like businesses are walking a tightrope here.
That's a great way to put it. They have to weigh the potential benefits of cheaper borrowing against the risks of increased volatility and uncertainty.
So for those business owners listening, what are some smart moves they can make to navigate this whole declining T-bill situation? Any insider advice?
First things first, don't panic. Stay informed about what's happening with interest rates, both globally and locally. Keep a close eye on those currency markets, especially if your business relies on international trade. But here's the real key. Have a solid risk management plan.
Risk management, love it. It's like having that safety net for when things get a little bumpy. And you know what? That's not just good advice for businesses either. It's crucial for us individual investors too. So let's switch gears a bit and really dig into those other investment options we touched on earlier. I'm ready to explore the world beyond T-bills.
Sounds good. Well, why don't we start with an old familiar face? Fixed deposits.
Yeah?
They've been a staple in Singapore, forever known for their simplicity and stability.
Right. You park your money for a set amount of time at a specific interest rate. No surprises.
Exactly. It's like the comfort food of investing.
But as you said, the returns on fixed deposits, they tend to be a bit on the lower side these days, especially with interest rates being what they are.
That's true. If you're really chasing those high returns, fixed deposits might not be the most exciting option right now. But they still have their place, especially for those who prioritize protecting their capital and getting that predictable return, even if it's not huge.
Okay, so it's less about getting rich quick with fixed deposits and more about playing it safe and earning a little something extra along the way.
Exactly. Now let's move on to something a little more dynamic. Singapore's savings bonds.
SSBs.
Exactly. They've been gaining popularity lately, and for good reason.
Yeah, they seem to offer a nice balance of flexibility and potential returns.
They do. And one of the best things about SSBs is you're not locked into a fixed maturity date like you are with a fixed deposit.
Right, you can cash out anytime without penalty.
Exactly.
Right.
Which is a big deal for a lot of people.
It is, gives you options.
Yeah.
And I also like that they have those step-up interest rates.
Right. The longer you hold an SSB, the higher the interest rate you earn, encourages a more long-term approach to saving.
Okay, so it rewards patience.
Yeah.
But how do those interest rates stack up against, say, a fixed deposit?
Well, SSB interest rates are linked to the average yields of Singapore government securities, SGS bonds.
Okay.
And because those yields have been trending downwards lately, so too have the interest rates on SSBs.
So even SSBs aren't completely immune to these global forces impacting interest rates.
Not completely.
Right.
But even with those recent adjustments, SSBs are still a solid choice for investors here who are looking for that balance of flexibility and potential returns. And of course, they're still backed by the Singapore government.
True enough. Okay, let's shift gears a bit again. What about endowment plans? Those always sound kind of sophisticated.
They do have a certain ring to them, don't they?
They do.
Endowment plans are often marketed as a way to grow your wealth while potentially having some insurance benefits built in.
Okay.
They usually involve investing a lump sum for a fixed period, often several years.
Right.
And they do offer the potential for higher returns than you might find with D-bills or fixed deposits.
Higher returns, always music to my ears.
Mm.
But what's the trade-off? There's always a trade-off.
You're absolutely right about that. And with endowment plans, the trade-off is liquidity.
Okay, what do you mean?
They require a longer-term commitment. To get those potentially higher returns, you usually have to stay invested for the entire duration of the plan.
So if you need access to that cash quickly, an endowment plan might not be the best fit.
Exactly. Now, in terms of those returns, they're not guaranteed like you would get with a fixed deposit.
Oh, so it's a bit more of a gamble.
Their performance depends on the underlying investments within the plan. Many endowment plans in Singapore invest in a mix of different assets, which helps to spread the risk.
Diversification. It's like the golden rule of investing.
It really is. But the key takeaway with endowment plans is patience.
Okay.
You're typically in it for the long haul. While those higher potential returns are tempting, it's important to really consider your financial goals, your risk tolerance, and how long you're willing to invest before jumping in.
Great advice. Now let's talk about something a little more, shall we say, daring corporate bonds.
Ah, you're ready for a little more excitement.
Always. So tell me what makes corporate bonds riskier than some of these other options we've been discussing?
Well, with a corporate bond, you're essentially lending money to a company.
Okay.
And just like with any loan, there's always a chance the borrower, in this case the company, might have trouble paying back what they owe.
So you're kind of betting on a company's success.
Yeah. In a way, yes. Which is why it's so important to do your homework. Before you even think about investing in corporate bonds, you need to research the company thoroughly. Look at their financials, their track record, their overall stability.
So a bit more due diligence required than with, say, a fixed deposit.
Exactly. And even if a company seems rock solid on paper, there are always external factors that can affect bond prices, things like interest rates and overall economic conditions.
Right, it can be unpredictable.
It can. So to answer your earlier question, corporate bonds might be a good fit for investors who have a higher risk tolerance, a longer time horizon, and are really looking for those potentially higher returns.
Makes sense. It's all about finding that balance between risk and reward.
Okay.
I'm curious about U.S. Treasury bills. How do those work? Are they basically the same as Singapore T-bills, just with an American twist?
They're both short-term debt securities backed by their respective governments.
Right.
The main difference is U.S. Treasury bills are issued in U.S. dollars, which means you have to factor in currency risk.
Because if the U.S. dollar weakens against the Singapore dollar, it can impact your returns when you convert the money back.
Exactly. It's an added layer of complexity. But despite that currency risk, U.S. Treasury bills have been getting some attention from Singaporean investors because they do have the potential for higher yields compared to what we're seeing domestically.
So potentially more reward, but with the added risk of those currency fluctuations.
Exactly, which is why they might be more suitable for investors who are comfortable with that uncertainty and are really seeking those potentially higher returns.
Okay, so we've covered a lot of ground here. Fixed deposits, SSBs, endowment plans, corporate bonds, U.S. Treasury bills. It's a lot to take in. But there's one more option I want to touch on, and it's not about stocks or bonds or any of that traditional stuff.
Let me guess you're talking about investing in yourself.
Bingo. In this day and age, knowledge is power, especially in the world of finance.
You got that right. We've gone through a lot of investment options today, each with its own risks and rewards.
We have.
But the most valuable investment you can make is in your own financial literacy.
Couldn't agree more. And thankfully, there are tons of resources out there to help people do just that. Books, podcasts, online courses, workshops, a lot of them completely free.
Exactly. And it doesn't matter if you're just starting out or you've been investing for years, there's always more to learn.
So along with diversifying your portfolio, it's a good idea to diversify your sources of financial knowledge too.
Absolutely. Remember, investing isn't just about picking the right stocks or bonds. It's about making informed decisions that will help you achieve your long-term goals.
Well said. Okay, we've covered a lot of ground, but I have a feeling some listeners might still be wondering, with T-bill rates going down, what's the right move? Is there a one-size-fits-all answer?
It would be nice if there was a simple answer.
Right.
But as we've seen today, the most important thing is to have an investment strategy that makes sense for your individual situation, your risk tolerance, and your financial goals.
So it's not about blindly following the crowd. It's about creating a personalized plan.
Exactly. And remember, you don't have to do it all alone.
Right.
Talking to a qualified financial advisor can be incredibly helpful. They can help you put together a plan that takes all those factors into account, your risk tolerance, your goals, your timeline, and helps you work towards financial success.
Like having a personal guide in the often confusing world of finance.
Exactly. So to recap, we've talked about why T-bill rates are declining, what it could mean for the Singaporean economy, and we explored a whole range of alternative investment options.
It's been quite the journey.
It has. But we're not quite done yet. There are still some important questions to consider as we wrap things up.
Right.
We've thrown a lot of information at everyone today.
We have. It's been a lot to process. So
Yeah.
let's cut to the chase.
Yeah.
With these T-bill rates going down, should investors be worried? Like, is it time to ditch everything and hide our money?
I wouldn't say panic is the right response.
Okay.
It's more about adapting and maybe making some adjustments. If you're really relying on T-bills and you want to see bigger returns, now might be a good time to seriously look at those other investment options we talked about.
So maybe dipping our toes into those corporate bonds or
Sure.
testing the waters with those U.S. Treasury bills.
Exactly. Just remember, with those higher potential returns comes more risk. You really need to understand what those risks are before you make any big decisions.
And that's where doing your research, knowing your own risk tolerance, and maybe even talking to a financial advisor can make a huge difference.
Absolutely. And here's something else to think about. As technology keeps advancing, are we going to start seeing even more new and innovative investment options popping up?
Ooh, that's an interesting thought. I mean, we're already seeing Things like robo-advisors and fractional shares becoming more common, making it easier for people to invest.
Exactly. And with all the advancements in blockchain and AI happening, who knows what exciting opportunities are just around the corner.
It's definitely an exciting time to be investing. But no matter what changes come along the way, those basic principles of diversification, managing your risk wisely, and making sure your investments match your financial goals, those will always be important.
I completely agree.
Well, that about wraps up another Deep Dive episode. We talked about those declining T-bill rates, explored the world of alternative investments, and hopefully gave you some things to think about for your own financial journey.
It's been great diving in with you.
As always. And until next time, remember, knowledge is power. May your investments be profitable and fulfilling.